Hey everyone, and welcome to our explainer on what is literally a historic moment in modern finance. Record highs are hitting across the board, right? Today, we're going to break down exactly how global markets are pulling off these massive numbers. We'll also dig into the core macroeconomic data that's actively driving this unprecedented growth. And finally, we'll try to figure out where the economy is actually heading next. Let's jump in.
All right, let's dive straight into this absolutely massive number, 50,000. For the very first time in history, the Dow Jones Industrial Average has pushed past 49,910 to officially hit this monumental milestone. And it's not just the Dow. The S&P 500 and the Nasdaq, they're sitting at absolute record highs too. This whole rally is being heavily fueled by the massive boom in artificial intelligence, with giant tech corporations really leading the charge. Ultimately, this incredible market performance is flashing a resounding signal of strength for the overall U.S. economy.
So, to make sense of this historic run, here's our roadmap for today. First, we'll unpack the macro trends pushing the Dow to 50K. Then, we'll examine geopolitics and global trade. Third up is commodities and crypto markets. Then we'll transition into corporate earnings, and finally, we'll wrap things up with the 2026 market outlook.
Okay, part 1. Macro trends and the Dow 50K, decoding the U.S. economy's historic run. Let's look at the foundational data right now.
Right now, the U.S. market is the single best performing major market globally. It's completely leaving the rest of the world in the dust. Over the trailing 12 months, the S&P 500 has delivered a staggering 31% return. That is huge. Plus, expected annual earnings growth is sitting at a really healthy 16%. So what's powering this engine? Well, it's driven by that AI boom we just mentioned, a super resilient U.S. dollar, and total U.S. energy independence. Because global investors are just pouring capital into this market, BlackRock's tactical view is still incredibly bullish on U.S. equities for the next year.
So let's see how this all builds into the broader economic picture. The labor market is remaining surprisingly strong. The private sector just added 109,000 jobs in April, comfortably beating Wall Street's estimates of 84,000. But the real friction here? It's inflation. Core inflation, which excludes the bumpy food and energy prices, remained incredibly sticky at 3.1% in January. So because of this unexpectedly hot job market and inflation still sitting well above that ideal 2% target, the Federal Reserve has kept the current interest rate totally frozen between 3.5% and 3.75%. It's basically a classic scenario where central bankers are feeling absolutely no urgency to cut rates.
Now, if we look a little closer at that Federal Reserve decision, it reveals a situation that was anything but unanimous. Sure, the Fed kept rates unchanged for the third consecutive time, but the deeply divided 8-4 vote? That actually creates the highest level of internal dissent we've seen since 1992. You've got some officials desperately wanting to cut rates right away, while others are actively discussing the very real risk of a rate hike. Chair Jerome Powell specifically cited tensions in the Middle East and rising oil prices as the main culprits pushing this inflation upward. The immediate takeaway for us? Mortgage and car loan rates are going to stay expensive, firmly pushing any hopes for a rate cut past May.
And, adding to this already complex macro environment is a massive upcoming leadership transition at the central bank. Jerome Powell's 8-year run officially ends on May 15, 2026. Taking the reins the very next day is the newly nominated chair, Kevin Warsh. Now here's the kicker. Warsh has explicitly stated that he doesn't believe in using forward guidance to telegraph rate decisions ahead of time. Wall Street absolutely hates surprises, right? So without that guidance, every single Federal Reserve meeting is going to turn into a high-stakes guessing game, injecting a massive amount of uncertainty into the markets.
Moving on to part 2, geopolitics and global trade, war, tariffs, and the fight for supply chains. Let's shift our focus to those international disruptions.
Remember a minute ago when I said Jerome Powell mentioned Middle East tensions? Well, here's exactly how that conflict is actively disrupting global supply chains. Following recent airstrikes, the Strait of Hormuz has been effectively blocked off, which is throwing global energy markets into total upheaval. Because of this, Brent crude has been wildly fluctuating between $97 and $114 a barrel. And that's pushing U.S. gas prices significantly higher. But there's a massive catalyst developing. Pakistan is currently mediating a 14-point peace deal. If this deal actually goes through and the Strait reopens, we could see global oil prices rapidly crash right back down to $70.
Intertwined with that ongoing physical conflict is a pretty major escalation in international trade policy. The current administration just enacted an immediate zero exemptions 50% secondary tariff on any nation supplying military weapons to Iran. Now, since Russia and China support Iran through these supply chains, they are the direct, intentional targets of this severe economic policy. Unsurprisingly, right after this announcement, U.S. stock futures took a slight negative dip as traders started pricing in these new risks.
This shift clearly signals that we're looking at something way broader than just a regional conflict. It's really acting as the opening volley of an escalating economic Cold War.
Domestically, though, this complex tariff situation is facing some truly fierce legal headwinds. The U.S. Trade Court officially struck down the administration's second attempt at a 10% blanket global tariff, declaring it illegal right after the Supreme Court blocked the very first round. Global markets reacted to this ruling instantly. Major European automakers actually dropped sharply in pre-market trading. In response to all this chaos, the European Union is holding off on enacting their own retaliatory tariffs until July 9th, just to see exactly how these American legal appeals shake out. So, if you're an importer or exporter, the crucial takeaway here is simple. This trade war legal battle is far from over.
All right, Section 3, Commodities and Crypto Markets, Safe Havens in a Volatile World. Let's track exactly where the money is moving.
With all these geopolitical blockades and unpredictable global tariffs, it's really interesting to notice how different assets are reacting to the exact same global stress. Gold prices are staying elevated, doing exactly what gold does, acting as a traditional geopolitical hedge against the oil crisis unfolding in the Middle East. Silver, however, is telling a completely different story. It just surged 5% in a single day, entirely due to rising industrial demand in the tech and clean energy sectors. Meanwhile, Bitcoin is behaving like a highly volatile risk-on asset that some retail investors are just temporarily using as a safe haven. Keep in mind, though, if a sudden peace deal is reached, we could witness massive, immediate sell-offs in all of these protective assets.
Speaking directly about Bitcoin for a second, let's examine this specific number, $79,800. That's roughly where the primary cryptocurrency is trading right now. But honestly, the underlying volatility is the true story here. In just one single day of trading, we saw the price swing violently from a high of over $81,700 all the way down to under $79,800. So even as traditional Wall Street indices are hitting absolute record highs, Bitcoin is really struggling to maintain its footing. Until the geopolitical situation completely stabilizes, crypto firmly remains in the highly risky asset category.
Moving into Section 4, Corporate Earnings and AI, the two-speed economy. Let's zoom in on how these macro trends are creating some wildly diverging sectors.
We're currently witnessing a completely bifurcated economic environment. Basically, a two-speed economy that's creating massive, distinct corporate winners and losers. On the tech side, artificial intelligence, cloud computing, and cybersecurity are absolutely booming, pushing the Nasdaq up toward that historic 26,000 mark. We're seeing established tech leaders like Microsoft and Salesforce surging over 2% in single daily trading sessions. But on the industrial side, heavy machinery manufacturers like Caterpillar are experiencing severe sell-offs, dropping nearly 4% recently. This stark contrast is a clear signal that institutional investors are growing increasingly worried about a physical industrial economic slowdown.
And we're actively seeing this industrial slowdown hit everyday consumers in very real ways. Take Whirlpool, for example. Their stock crashed a staggering 21% in a single day after they missed earnings and drastically cut their fiscal 2026 guidance. Management directly blamed the overseas war for cratering domestic consumer confidence and basically stalling out major appliance purchases. When a foundational appliance maker issues a dire warning like that, it's a massive early indicator of a broad recessionary squeeze. On the flip side, though, McDonald saw its stock rise 3.3%. That proves that financially squeezed consumers are actively ditching expensive dining for cheaper defensive value plays.
It's wild because even the absolute biggest names in the global market are facing a highly mixed bag of corporate signals right now. Tesla saw its U.S. shares pop 2%, driven entirely by intense investor hype around their AI and robotics divisions. However, over in China, their April automotive sales dropped over 7% compared to March as local EV rivals aggressively captured their market share. Then you have Boeing. They're projecting an incredibly promising 38.8% expected annual earnings growth over the next 3 years. Yet, they're currently carrying a massive debt load that just isn't covered by their operating cash flow, making them a very high-risk, high-reward investment.
We can also see exactly how major U.S. companies are physically restructuring their global footprints due to these rising international tensions. Starbucks has officially finalized a massive strategic shift. They're selling 60% of their China operations to a local private equity firm for $4 billion. By retaining only 40% of that regional business, they're actively limiting their financial exposure. This is a direct localization and cost-cutting strategy designed to completely insulate the coffee giant from the ongoing trade tensions we talked about earlier. It's literally a prime example of American companies quietly executing massive exit or restructuring strategies in overseas markets.
And finally, Section 5, the 2026 market outlook. What to watch next? Let's bring all this data together.
So, after digesting 50,000 on the Dow, massive geopolitical blockades, and wildly divergent corporate earnings, the true trajectory of the market really relies on three interconnected catalysts for the rest of 2026. First, the final outcome of that 14-point peace deal will single-handedly dictate the price of crude oil and global inflation. Second, the dawn of Kevin Warsh's new Federal Reserve regime in May will force investors to navigate upcoming rate decisions completely blind, without any forward guidance. And third, the ongoing Supreme Court battles over global tariffs will fundamentally reshape America's supply chain costs and international trade policy. These three pillars are absolutely going to define the remainder of the 2026 trading year.
Which leaves us with the most important strategic question of all for your personal finances. As the Dow breaks 50,000 amidst this crazy backdrop of war, sticky 3.1% inflation, and a totally unpredictable central bank, how are you defensive-proofing your portfolio? Are you aggressively leaning into artificial intelligence growth, or are you actively seeking out safe havens like gold and defensive consumer stocks? We highly encourage you to apply today's structured macroeconomic analysis directly to your own investment strategies. Thanks so much for joining us for this explainer, and be sure to subscribe for more deep dive analyses.